Hi, this is Prashil, and you're listening to the Equity Master Stock Market Wrap Up. In today's edition, I'll be taking you through what moved the markets over the week. So let's jump right in. We'll be taking a look at the year gone by and how benchmark indices performed in 2018 and the way forward. Are Jet Airways' woes set to get worse? Another PSU bank merger just got approved. Manufacturing activity is easing, but there's good news in store. Now, a quick look at the broader markets. Asian and European indices were trading volatile after a shock earnings guidance downgrade by Apple, which brought US stocks tumbling down. Back home, Indian indices witnessed a volatile week and ended the week in positive territory. With the markets out of the way, let's look at the key stories in focus today. As we enter 2019, a look back at 2018 throws up some interesting trends about how the local market performed in the year gone by. The BSE Sensex closed just above the 34,000 mark at the end of 2017. It gained 14% to hit a lifetime high of 38,897 on 28th August 2018. Thereafter, the Sensex was in correction mode throughout September and October. However, after hitting a year-to-date low of 33,349 in the last week of October, the Sensex reclaimed the 35,000 level in December. Now that's a 6% gain for the Sensex in 2018. For equities, that's not a good enough return. Your money could have done better parked in fixed deposits. While the Sensex has shed most of its gains in 2018, it still doesn't appear to be so bad in Indian rupee terms. But for foreign investors, the fall in Sensex has been worse because they are also exposed to the currency risk. No wonder that foreign investors have been dumping Indian stocks. Since April 2018, foreign investors have sold equities worth 565 billion rupees. What is worth noting is that 276 billion worth of equities were sold in the month of October alone. In fact, the total market value of all listed companies on the BSE declined 5% to 144 trillion rupees from 151 trillion rupees at the end of 2017. Now, as we enter 2019, will the trend continue or will stocks outperform? Now that's a question that's on everybody's mind. But we'll be sure to track all of the developments and bring them to you every week. Moving on, Jet Airways is in focus once again on reports that the cash-strapped airline has proposed lenders to securitize revenue from ticket sales against its outstanding debt. The debt-laden airliner, which defaulted on loan payments last month, is also said to have approached the upper division of officials earlier this week in pursuit of a rescue by state-run banks. On Thursday, ratings agency ICRA downgraded the airline's loan and debenture ratings. Further, Jet was in talks with the SBI for raising 15 billion rupees in short-term loans to meet its working capital requirements and some payment obligations. Reportedly, Jet Airways' strategic partner and Middle East carrier Etihad, which holds a 24% stake in the Indian full-service carrier, is likely to provide a guarantee for the loan. The Naresh Goyal-controlled airline, which has posted 3 consecutive quarterly losses of over 10 billion rupees each since March, already has as much as 80 billion rupees worth of debt on its books as on September 30th. Domestic airlines have been struggling to make profit because of a rise in operating costs. However, the new year began on a positive note for domestic airlines as state oil marketing companies slashed aviation turbine fuel prices by 14.7%, making it cheaper than even petrol and diesel in major cities. This will provide much needed respite to carriers like Jet Airways. It will be interesting to see if and how the debt-laden carrier turns around from this grim situation. Moving on, Bank of Baroda was in focus over the week as the Union Cabinet approved the merger of the bank with Vijaya Bank and Dena Bank. The boards of the banks met to approve the swap ratios earlier this week. For every 1,000 equity shares of Dena Bank and Vijaya Bank respectively, investors will get 110 and 402 equity shares of Bank of Baroda. Speaking of the banking sector, credit growth for banks is back to its 5-year high now. The credit growth that banks in India posted in the December quarter of 2018 at 15.1% year on year is not just very healthy, it's nearly 2 times the GDP growth. Strong credit disbursal is clearly a sign of better things to come. Higher consumption demand, better capacity utilization, more capex, and higher profits. This is indeed a positive trend in the economy going forward, so we'll be sure to keep an eye on that. Moving on, India's manufacturing activity expanded at a slower pace in December as compared to the previous month. This was seen as growth in new orders and output waned despite factories cutting their prices. Going by the numbers, the India PMI or the Purchasing Managers Index declined to 53.2 in December, below November's 54.0 reading. The December reading, however, was above the 50 mark for the 17th consecutive month. Notably, the 50 mark is what separates contraction from expansion. Coming to the good news, manufacturing activity registered its strongest quarterly performance since late 2012. Although new orders and output expanded at a slower rate last month, both remained well into expansion territory for more than a year, supported by weak inflationary pressures. December also saw the weakest increase in input costs for nearly 3 years, giving factories room to cut their prices for the first time since July 2017. Despite a strong performance in 2018, the survey indicated manufacturing firms were turning cautious. Hiring in December slowed as optimism waned amid uncertainty ahead of the national election scheduled for May. It will be interesting to see how the manufacturing activity performance pans out in the coming months. Well, that's all from us today. Before signing off, we would like to know if you like our podcast. Is there anything specific you want us to cover? We would love your feedback. Just visit equitymaster.com and drop us a line. We look forward to hearing from you. Happy investing!